Fellow risk takers, this is your worst. Podcast host Andrew Stotz from A Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry's unique because he understands the academic research world as well as the practical world of investing. Today, we're going to discuss a recent chapter in his book, Enrich Your Future, The Keys to Successful Investing. And the chapter is number 15, Individual Stocks Are Riskier Than Investors Believe. Larry, take it away.
Yeah, well, individual stock selection certainly offers the attraction of the potential for spectacular returns. NVIDIA would be the latest example. Over the last few years, the returns have been spectacular. The problem with that is not only, as we discussed, that the market is highly efficient, making it difficult to identify stocks that are undervalued, okay? But most people fail to understand that individual stock selection is dramatically riskier than owning a broad selection of hundreds or thousands of stocks, which is why diversification has been called the only free lunch in investing. So if we think about this, the stock market over the last roughly 100 years has returned, let's call it roughly 10%. And the standard deviation on an annual basis of a portfolio of a broad market of stocks has been about 20%. Okay. What most people don't understand is that the average individual stock has a standard deviation of more than twice that. So you have, obviously, since all stocks got 10%, on average, if you own stocks, you got 10%. But if you own one stock or even a few, you've got twice the risk and no higher expected returns. So why do people own individual stocks? Well, one is there's that hope of winning the lottery. And two, I think we can agree that one of the most common human traits is overconfidence. We think we can, do better than the average investor. So what we hope to do here tonight is to show people how bad the odds are and why you shouldn't play that game unless maybe you have an entertainment account. Take a couple of percent of your portfolio, like you might take to a casino or a racetrack for entertainment purposes, but don't put your retirement at risk by buying individual stocks. So let's look at some of the data. There was a study done from 1983 through 2006, and it covered the top 3,000 stocks. Okay. During that period, the stock market returned almost 13% per annum. The median return was just 5.1%, almost 8% below the return of the market.
And can you
And
explain median return for those people that may not get that?
the mean is the average return of all the stocks. The median is half the stocks got above and half got below. So half of the stocks underperformed by almost 8% a year. Now, here is the more striking thing. The average or the mean annualized return was minus 1.1%. So if you just randomly pick one stock, the odds would say you were more likely to get minus 1.1. Now, here's the way you have to think about stock buying individual stocks. The returns are not normally distributed like they would be in a bell curve. So if we have a bell curve and we drew a line down the middle and say the mean would be 10%, you would think that half of the returns would be above 10 and half would be below 10. But we just went through an example where the mean was, the average return was 12.8, but the median return wasn't 12.8. It wasn't even close to that. It was 5.5. Okay. And the average compound return was minus 1.1. And you get that because you get a few stocks that return 5,000%. Okay. So you need that. So the way to think about this is if you own the market or hundreds and thousands of stocks, the odds are great you're going to get very close to that mean return. In that example, it was 12.8%. The fewer stocks you own, now you look more like a lottery ticket. Now, the lottery ticket, the mean return is minus 50% because the state keeps typically half of the revenue. But most of the returns are minus 100%. So if you buy one ticket, the odds are great you're going to get minus 100% is the most likely outcome. And that's the problem. The other problem that we've seen, and we've talked about Henrik Bessenbinder's work, but he did a study and he found that less than half of the stocks had a higher average monthly return than 1 month T-bills. So your T-bills have virtually no volatility at 1 month, and you got less return than that, and you're having, 40 or 50 times that volatility, right? Even over a decade of even over a horizon of a decade, a minority of stocks outperform T-bills, not the market, but treasury bills. Okay. The numbers are so compelling that you really shouldn't try. And we know, as we've discussed many times, that the typical professional investor, mutual funds, and they underperform after their cost. So you have to ask yourself, outside of the entertainment value, what are the odds that you're going to win that game? Which is why you shouldn't play and why more and more people are abandoning active stock selection. When I started in the business 28 years ago, the index funds were a few percent of investment strategies. Today, we see estimates of about half of investors are now. So clearly, now we have probably getting very close to majority of investors have given up that hope and taken experience and wisdom over hope by indexing and owning broad market-based strategies.
It reminds me of the movie Dumb and Dumber, which came out in 1994. And Jim Carrey, of course, was the lead actor. And he was infatuated with a lady in the movie named Mary Swanson. And she was played by Lauren Holly. And he was standing in front of him. Here he is, this goofy, not particularly smart guy, trying to figure out if he had a chance with this woman. And the dialogue goes like this: what do you think the chances are of a guy like you and a girl like me, which he got confused because he's not very smart, ending up together? And Mary says, not good. And Jim Carrey says, not good, like 1 out of 100. And Mary replied, I'd say more like 1 out of 1,000,000. And he replies after a long pause, so you're telling me there's a chance?
Well, to relate that to stocks, Bessenbonder found that 100% of all the excess returns were earned by just 4% of all of the stocks. You have to look in the mirror and say, what are the odds that you could find that NVIDIA before everyone else discovers it? And it's trading, at some crazy multiple already, and it's already returned 1,000%. The odds are clearly low, but it's possible. And, as Woody Allen said, hope is that thing without feathers.
So but this one kind of blows your mind because what we're understanding about the market and the opportunity to pick stocks, it really blows your mind. But what you've explained too is the way that indices are constructed generally is going to be market capitalization weighted. And therefore, index or passive funds are going to try to track that through a market capitalization weighted methodology. And in a market capitalization weighted methodology, it means that those stocks that are going up massively are going to get more weight than the tiny stocks that they could go up massively, but they're not going to get the weight into the index. And therefore, what I believe you're telling us is that by owning that index or passive fund, you are going to capture that average return. But if you're just trying to build a portfolio of 10 stocks or something like that, you may have diversified your portfolio, but the likelihood that you're going to catch that very tiny percentage of really high performing return stocks is just so low that you'll almost always underperform the passive fund. Would that be a correct characterization of
Yeah,
what you're
it's a
saying?
good way to think about it. And Bessenbaum have found, maybe even a more amazing statistic, out of all the stocks over the century of data he looked at, less than 1% accounted for more than half of the wealth accumulated in the market. I mean, so if you think about it, the way I try to teach people to think about this, think about a bell curve. Okay. And the mean is your average return. If you own the market, you're guaranteed to get that mean return. Now, we don't know what it will be, unfortunately, right? Could turn out in the next 10 years, we'll get 7% or 2% or 20%, right? We don't know what that number will be. But whatever it is, you're guaranteed to get it. Now, think about if you had a chance to own a portfolio that had a taller, thinner distribution for a bell curve. So instead of bell curve being wide, where you could get, really spectacular returns, but also really awful returns, that's owning individual stocks. You have the chance, but it's weighted far more to the left, where you can get really awful returns more likely and a low probability of getting their spectacular returns. Now, if you could own the taller, thinner bell curve, has the same average expected return, but you give up the opportunity to hit that home run, owning the NVIDIA only. But now you eliminate the left tail risk because stocks on average go up and they don't lose 100%, right? Unless you happen to live in Russia in 1917, right? But at any rate, since the average investor, we know, or not just the average, the vast majority of investors are highly risk averse. The only logical strategy is to choose as the strategy the taller, thinner bell curve, getting rid of the left tail risk as the sacrifice for the small opportunity to hit the home run. And yet half the investors today are still playing what we would call the loser's game of trying to hit that home run.
And one last thing for me is one of my guests on episode 667, his name is Shri, and he was the one that introduced me to Bessenbinder's research originally. And I went through it and saw it. And what he saw was a great opportunity, because he said, I have the skills to find that small number. I don't need to worry about 20,000 stocks around the world. I'm just going to focus on 100 that fit the parameter, then bring that down to the 20 or so that I'm going to hold in my portfolio. And I'm going to, be able to outperform as a result of that. What would you say for the expert that's listening to this and thinking, yeah, this just tells me that, I'm going to use my skills to get into that little space?
Yeah, well, the first thing I would say is look in the mirror and see if you see Warren Buffett. We know the vast, vast, vast majority of professionals who have PhDs in finance and spend 100% of their time engaged in this activity have access to the best databases in the world and have teams of professionals helping them. And they have been typically highly unlikely to outperform. What makes you think you have enough of an advantage over them? What advantage, if any, do you have over them? The answer is almost certainly none, and therefore you shouldn't play the game. Now, it's possible, you have some inside information that gives you what you think is an advantage. Even then, I'd be careful to think, are you really the only one who knows that? Is that not embedded already in the stock price? Perhaps not. But remember, it's also illegal to trade on that.
Yeah, and it just there are some people in the markets that focus on these tiny little niches where they figure out something in this little niche that causes this particular stock to go up by 10 times. Now that stock's never maybe ever going to be one of these super large cap stocks like Nvidia, but they went into a space where nobody, was. But that's not what we're talking about here. When you talk about the small, tiny number of stocks that are outperforming, you're talking about large cap stocks that are getting bigger and bigger and bigger.
Well,
And
once they were small and then
yep,
they become large,
right.
right?
And when they
I mean,
become large is when they're having that impact. And what I'm saying is that what's the chance that an individual sitting in Chicago has some kind of competitive advantage in a company like Nvidia? Very, very unlikely compared to building some kind of uniqueness in a tiny little niche of the market.
yeah. And, look, the evidence is very clear. It's
Mm.
possible to win. That's what attracts people. That's what attracts people to betting on sports, even though they know the average person, gets taken to the cleaners. And many people end up in bankruptcy and even committing suicide because they've lost fortunes. One of the worst things that happens is countries legalize gambling. Now you got companies that are exploiting addictions that people have, and you see more bankruptcy, more credit card defaults, more mortgage defaults because people get addicted and they start off thinking they're smarter, better, and then they get hooked, and it's a loser. The stock market is no different. They've actually run tests where they wire your brain, and people who are online trading like this, it's exactly the same part of your brain that's reacting when people are at the roulette wheel or at the slot machines or at the racetrack and they're gambling. No difference at all, but people don't recognize them.
A great book that I read many years ago that illustrated that was Your Money and Your Brain by Jason.
Jason Sward's book. Yeah.
Yeah, excellent book.
Great book, by the way. Yeah.
Yeah. Larry, I want to thank you again for another great discussion about creating, growing, and protecting our wealth. And I'm looking forward to the next chapter, chapter 16. All crystal balls are cloudy. For listeners out there who want to keep up with all that Larry's doing, make sure to go to Twitter at Larry Swedroe, and you can find him also on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.